If you've been watching the markets, especially some of the big tech names, you've probably seen it.
Oh, yeah.
That familiar wave of anxiety around one of the most watched stocks out there, we're talking about TSLA, of course.
Of course.
It took a pretty big hit, a $15 dip, after some really pessimistic forecasts about Q4 delivery started making the rounds.
It's pure fear. I mean, that's what you're seeing. The market sees what it thinks is a volume slowdown, and the gut reaction is just sell, right? Sell now, figure it out later.
Right.
But the analysis report we've pulled together for you today, it's this incredibly detailed contrarian take, and it basically argues that all this selling is completely missing the point.
Missing the point. How?
The report's core idea is that this short-term panic is setting up, well, a classic bear trap.
And that's our mission for this deep dive, to figure out why. You've got the market screaming about a delivery problem, but this report is saying the smart money is quietly loading the boat. How can you have two groups of, really informed analysts at major banks look at the same company and come up with such different numbers? You've got targets like $247 on one side and much, much higher on the other.
But that's the key question, isn't it? The confusion and, frankly, the opportunity for you, the listener, comes from this really fundamental disagreement on how you even value the company anymore.
So what's the disagreement?
You've got analysts like at UBS who just cut their target to that 247 number. They are stuck in the past, thinking of it as an automotive company.
Just cars.
Just cars. So they're obsessing over these little short-term bumps in volume, the end of some government subsidies. Meanwhile, you have others like the Stifel analyst the report mentions who are focused on something totally different.
And that would be?
The software.
Yeah.
The energy business. The AI. That's where the real financial shift is happening.
So the question for us today isn't really how many cars did they sell last quarter?
No, not at all.
It's more like, what are the deep structural changes that this contrarian view thinks will just completely wash away all the noise about deliveries? What are we missing if we only look at the number of cars coming off the line?
We have to get past the spreadsheets just counting units sold. We have to look at what the profit and loss statement is really about to become.
Okay, let's unpack this. So first, we're going to lay out the bear case, the bearish argument, in detail. Figure out what exactly caused this panic.
Got it.
Then we'll dive into the two big shock factors, software and energy, that the report argues could completely flip the script on the Q4 earnings call.
Let's do it.
All right, let's start with where all the pain began. The delivery estimate cuts. This is the main reason for the bearish mood and that stock drop we saw.
Precisely. The noise really hit a peak when UBS put out their note. They explicitly cut their Q4 delivery numbers down to about 415,000 vehicles.
And the consensus was what, 435?
There's 435, yeah. So that's a 20,000 vehicle cut. That's not insignificant. People notice that.
Okay, but let's get specific. They mentioned a subsidy hangover as the reason. That sounds a little vague. What does that actually mean?
Yeah, it does need some context. The analysis points out that the whole bearish case is leaning really heavily on these recent changes to the U.S. federal tax credits.
The eligibility rules.
Exactly. For most of the year, a bunch of their models got these big credits, which, obviously drove a lot of demand at the end of each quarter.
Sure.
But heading into Q4, some of those rules got tighter, especially around where the battery components came from. So the bears are arguing this created a sudden drop in demand. A hangover.
A hangover from people rushing to buy earlier in the year to get the credit before it changed?
That's their argument. A pull-forward effect.
So the short-term view is a policy change creates a headwind, fewer cars get delivered, and they plug that disappointment into a traditional car company valuation model.
And that, according to this contrarian report, is the central flaw. The report is actually pretty harsh. It says they're viewing the company as just a car company and are obsessed with volume.
They're getting caught in a trap.
A trap. Because they don't see that the stock isn't trading on last quarter's volume anymore. It's trading on future margin potential.
Okay, but let me push back on that for a second. Even a software company needs a platform, right? And in this case, the car is the platform.
It is, yeah.
So if volume stalls, doesn't that by definition limit the number of people who can use the FSD software? Doesn't it limit the data they need to train the AI? You can't escape that hardware-software link, can you?
That's a really sharp point, and the report does address that. It makes a distinction between the volume growth rate and the sheer scale of the volume.
Okay.
They're saying, look, even if the Q4 growth number is a little disappointing, the total size of the fleet is already massive. It's a huge data moat for developing FSD that no one else has.
So a 20,000 car miss is just a blip.
It's a blip, exactly. It's a blip if the amount of money you make per vehicle is about to go up exponentially because of software.
Which sets up the contrast perfectly. You've got volume, which is a bit down, versus potential future margins, which could be about to change everything.
And it's an enormous difference. If you're just counting cars, you're thinking about a PE ratio like a traditional manufacturer, maybe 8 to 15 times earnings.
Right. Ford, GM.
Exactly. But if you're actually becoming a recurring software and AI company, you're looking at PE ratios of, 100, maybe even 300. It's a different universe.
This brings us right to the first big shock factor that the bulls are watching, the software flip. Instead of counting cars, this contrarian view is locked in on the software code.
Here's where it gets really interesting. The specific focus is this recent release of FSD, version 14.2.2. Analysts like Stifel seem to think this isn't just another update. They think it's a major technical leap.
What's so special about this version, 14.2.2? The analysis quotes Stifel praising its, and I'm quoting here, human-like decision-making and zero hesitation lane changes. That sounds, I don't know, very subjective.
It is subjective, you're right, but it points to a really critical technical milestone. Reliability.
In complex situations.
Yes, in complex real-world situations. The older versions, they would often hesitate with things like unprotected left turns or merging into heavy traffic.
Where hesitation is a problem.
A big problem. The improvements in this new version suggest the core architecture is getting better. The neural network is planning better. It's more decisive. And that's what takes it from being this, cool beta project to something you can actually sell as a reliable service.
And that's where the money is. So let's talk about the financial side of this, because this is the core of the whole shock idea. We know automotive margins have been getting squeezed down around 15% because of all the price cuts.
And 15% is basically the best you can hope for in a manufacturing business. FSD just shatters that.
It's a totally different model.
It is. When you're talking FSD, you're talking about pure software margins. We're talking 70%, maybe even higher. Once the code is written, the cost to sell another copy is almost zero. The whole long-term value of the company depends on how fast that high-margin software revenue grows.
Which brings us back to valuation, that PE ratio, the one that scares all the traditional auto investors.
That's right. The report makes the case that a PE of 300, which looks absolutely crazy for Ford, suddenly becomes a lot more justifiable if you're pricing in that future software growth.
Like Amazon back in the day.
Exactly like Amazon or Microsoft in their hyper-growth phase. Their PE ratios looked insane, but the market was betting on this massive high-margin expansion, not just what they sold that quarter.
But the critics always say FSD has been just around the corner for years. So if you're banking the whole valuation on this future software revenue, aren't you just adding more risk on top of the car sales volatility?
And that is the absolute core risk the bears point to. But the contrarian analysis says you have to look at how that revenue is actually recognized.
On the books.
On the books. Right now, a lot of the FSD payments are deferred. The company gets the cash, but they can't count it as revenue until the features are all delivered. What the bulls are looking for on the Q4 call is any signal that the company is about to change that.
A change in accounting, basically.
A change that reflects the software's maturity. Maybe they start recognizing the lifetime value of the software sooner, or they launch a subscription model that everyone accepts. Any hint of that would be huge.
So the earnings call is less about cars and more of a roadmap update for their AI and software business.
That's it. Especially as we get closer to that 2026 target for the robotaxi rollout. That service is how you monetize FSD on a massive scale without even needing to sell cars to people. The closer that gets, the more that PE ratio gets tied to that high-margin future, and the less Q4 car sales matter.
Okay, so we have this software flip, which is high risk, high reward. But the report also brings up a second factor, something that stabilizes the whole thing. The sleeping giant, Tesla Energy.
This is such a critical piece of the puzzle. It's about balance. The auto business goes through cycles, price wars, competition.
Sure.
But the energy segment is tied to something much bigger and more stable. The global need to upgrade our electrical grids with massive battery storage. It's a totally different market.
And the report says that even while auto deliveries might be soft, energy storage, specifically those big mega packs, they've been hitting record highs. Is that really enough to move the needle financially? Is it a massive cash cow?
It is becoming one, yeah. The growth in gigawatt hours they're installing is actually accelerating faster than vehicle deliveries.
Yeah.
And what's really important is the margin on the megapack business is way better than the squeezed car margins.
Okay.
And the analysis stresses that the backlog for these megapacks is huge. It gives them this multi-year predictable stream of revenue that acts as a buffer against any quarterly swings in car sales. It keeps the lights on and funds the R&D.
And all of that stability feeds into the company's overall financial strength, which this report sees as basically unassailable. Let's talk about the balance sheet.
This is their big macroeconomic advantage. The report is very specific. They are sitting on over $41 billion in net cash. And, importantly, they have almost no operational debt.
$41 billion in cash. Just put that in context for us. Why is that specific number so important right now as a counter-argument to the bears?
Because we're in a high interest rate environment. Capital is expensive. Most of their competitors are loaded with debt. It costs them a lot to borrow money to invest.
So that cash is a weapon.
It's their ultimate strategic weapon. The report argues that $41 billion gives them the freedom to weather any storm. A recession, a slowdown in car demand, and, this is the key part, it lets them invest aggressively in AI, in supercomputers, in FSD, while everyone else is cutting back. It fuels that software pivot we were just talking about.
Okay, so bringing this all together, you have the market panic, which is the UBS view focused on volume, looking backward at sales. And then you have this quiet optimism, the Stifel view, focused on software and energy, looking forward to margin growth and stability.
Exactly. It's a difference between valuing a company on how much steel it sells versus how much intellectual property it owns and can monetize. Right now, the market is pricing in the worst-case scenario for steel.
And because that bar is set so low, it creates the perfect setup for a shock on the Q4 call.
That's the idea. If Q4 earnings just come in as decent numbers, not a huge beat, just solid, and they pair that with a strong 2026 roadmap for the affordable car and some real signals about FSD progress.
Well, with expectations this low, the stock could move up significantly.
So what does this all mean for you, the listener, trying to make sense of this volatility? The analysis seems to draw a very clear line between short-term noise and long-term signal.
It does. The report suggests the short term, the next few weeks, could stay choppy. You might even see it test that $440 support level as the bears push their story. That's the delivery numbers playing out.
But for the long-term investor, the one who believes in the software and energy story, for that person, the report basically frames this moment of fear as a strategic opportunity. It says buying the fear around these prices is a bet on that future margin profile. It's a bet that the market is just fundamentally mispricing where the company is headed.
So, in short, the current price reflects the disappointment in volume. But the real potential is all tied up in the software and the steady cash from the energy business.
Right.
Which brings us back to our key finding. The Q4 shock, if it comes, won't really be about how many cars they delivered last quarter. That's the low margin story. It will be about the high margin story from FSD, any hints about recognizing that revenue, and the quiet power of the energy segment.
And that leaves a really big question for you to think about. If a company actually pulls this off, if it manages to decouple its value from the physical world of manufacturing through software and energy, how fast are other companies going to try and copy that playbook? What does this mean for how we value any company that lives at that intersection of atoms and bits from now on?
That is a fascinating thought for the future of valuation. We really appreciate you joining us for this deep dive. Until next time, stay well informed.